Hey everyone, welcome to the second episode of Chapter 1A in the Market 0 to N series. So this one is about being active or passive, short-term or long-term. Now you guys may think this ties directly into being a trader or investor, and it's similar and related, but not exactly the same. So basically, when you're choosing trading or investing, you also need to choose active and or passive short-term or long-term, and they're not necessarily while they may be related to trading or investing, they're not necessarily completely defined in that way. And you gotta figure out what you're about, because it's not really just a preference, but it's going to help define your strategy, your risk, and your time commitment. So active, you'd think, okay, that means you're probably a trader rather than an investor. But what active really means, at least the way I'm going to define it to you, is that it means you're making decisions. You're choosing trades, you're choosing stocks, you're choosing entries, you're choosing exits, you're choosing investments. You're trying to outperform. Whereas passive means you're letting some sort of system do the work for you. Maybe that's an index fund. Maybe you have an automatic dollar cost average thing. Maybe you even have an algorithm written by your friend and you just let it work for you. The idea is that you're really just sitting and chilling. So as you can see, we got this couch potato. If this is you and you just like to relax, you probably should not be an active investor. Just take it easy, be passive. You can be a passive trader too if you have some friends that have written some sort of good code, but for the most part, you're likely to be a passive investor, and your goal is probably just to match the market, because beating the market while being passive is decently complex. Now, if you're a bit more willing to do your homework, to work hard, whether it's investing to be in the best companies that will really outperform at the best prices, or just trading, using the charts, finding out where buyers might be, where sellers might be, and just acting on that. Either way, if you feel like you want to do more, you might want to stray toward being active. But when it comes to time frames, you also got to think, do you want to be in for seconds to minutes? Well, then you want to scalp. Do you want to day trade? You don't want any overnight risk. In sometime during the day and you're out before the close. Swing trading might be days to weeks, and it might even be months depending on letting your trade run. And investing, typically speaking, we're talking years to decades. But as an investor, you might accidentally swing trade. You might be in this brilliant company long term, and then suddenly you realize, well, the prices ran up too quick, and your free cash flow model or whatever doesn't justify that price. So you end up selling before the 1 year mark. That doesn't mean you're no longer an investor. You might just be, getting out early. So you're really just an active investor at that point. So it's not fully related to time frame, but just think about what kind of time frame you are interested in. Are you willing to stray away from your interest? And ultimately, whether you're a trader or investor, the most important thing is, are you willing to put in that work? Because if you are, you can succeed in either one and beat the market. Where if you're not, you take the passive approach and just chill. If you try to half-ass it too much, put in a little bit of work here and there, it's a pretty competitive market, so you probably will not end up too well, but maybe if you're very talented, you will. But yeah. And just to really summarize it, when you're active, you have more control of your investments and, your performance. And with that being said, you may outperform. But with the con of that, and this is very obvious, is it's time consuming and there's a skill dependence. So you might even put in more work, do all that effort just to underperform the market. Being passive is very easy. It's stress-free for the most part. And it's pretty good for beginners to get into because you could read like one book and you don't know probably everything you need to know about how to invest in the S&P 500. But that being said, the main con is you got that limited upside. Like you're always gonna perform. Essentially, you're always gonna underperform the market because you're in an ETF and you have fees. So what people say is the S&P 500 return, you get almost that because you got a little bit of fees. So you're always underperforming. You don't have too much flexibility and you just can't do great. And with the rise of all this grifting and front running of index funds, index committee doing strange stuff, it's very hard to say if there's a good future for passive investors, but you got to think about what suits you at the end of the day. Now, with being short term, it's pretty good because you're looking at more opportunities, faster returns, and really faster feedback on your returns. You know whether you're right or wrong basically instantly, and you can really conserve your time. And with that being said, there's a huge con that you might be falling victim to the noise, whether that's just one bad news article that doesn't really affect the big picture. A lot of brokerages have costs, so you're looking at higher costs. Even if you have a so-called commission-free brokerage, which may or may not truly be commission-free, you still need to worry about the bid and ask spread. So you are still, having that disadvantage. And then when you're long term, it's quite simple. If you're in America, it's actually more tax efficient. If you're in Canada, it's the exact same. So you don't have that benefit. But at the end of the day, it is, generally speaking, it's pretty simple. And, you got this slow progress. You got to be extremely patient because you might have had a good idea and it takes many years to play out. And sometimes you might even be in a stock for years. And then you realize you were wrong, so you wasted your money and years of your time. So there's problems with long-term investing too. And for the guys who think index funds are very safe, the term lost decade is tossed around here and there. If you're not familiar with it, it's basically just a decade of zero returns. And it does happen. So you might be a nice, safe index investor for 10 years and make no money, which is pretty unfortunate. But anyway, think if you want to be hands-on, hands-off. And even if you want to be hands-on or hands-off, think about yourself and think about how much time can you actually commit, because maybe you're working a full-time job and you have a side job as well. So think about what you can actually commit. And also think about it, can you actually take frequent losses? Because sometimes you might need to do that as an active trader. Or would you rather just sit, chill, and not even look at your account for a long time? Figure yourself out. Start simple. Remember, you can always change. You can always evolve. And as your situation changes, you can always adapt to that. But yeah, start with what really suits you best. And just be like that. Don't overdo it.